Hey traders, welcome back to another trades review. So this is a perfect example, a perfect journal that showcase a consistently profitable trader. So if you look at the entire performance, the first thing that I would love to assess has always been the risk reward. I love seeing traders have a skewed, really high risk reward ratio, because I know even if I see a high risk reward ratio, that means even he has only a 30% strike rate, 20% strike rate, he is still going to come up profitable. So 6.48 R, 1 R, -1, -1, 8 R, -1, -1, and then 4.5, -1, 1.9, some losses here. But I want all of you to understand, all of these losing streaks, as long as you manage them well, they're not avoidable. You can never avoid losses as a trader, because sustainability is about how can you make sure your wins are bigger than your losses. That's it. Let it be you have a very high strike rate but lower risk reward. Let it be you have a low strike rate but extremely high risk reward. Whatever. Profitability is about finding a sweet spot. So go back to this one. Win loss, very even. Long and short, I believe is quite even, but I can see he focused a little bit more on the sell side. Limit order, everything. So patterns wise, he traded TPF, key level, squeeze, break and retest, range, continuation, pullback. All these are patterns that we teach inside our trade club. So let's have a look at pound dollar. So this is a perfect trade. So you can actually see, so pound dollar had a bearish structure. So we had a sweep of the high at that 128.10. We got a massive sell to the downside. We got a continuation there, continue pushing price lower, a break of this major structure, and we went back for a retest and a continuation. And this area matches with one of our key levels as well. So this is also a perfect example of an A+ setup. A+ setup technically means you got high time frame structure aligned, high time frame directions aligning. Structure and direction are two completely different things. Structure, it could be, is the market is on a pro trend, is it on a weak trend, is it on a healthy trend, is it on a parabolic trend. Direction means are we going up or down, that's it, or sideways. So this is a perfect example of an A+ quality setup. Then we got pound Aussie short, also another perfect continuation trade. So you got sell, massive sell to the downside, deep retracement. All these are what I consider a no trade zone, because this is when market really chopped a lot, and he saw that market was reacting to the prior resistance here, quite a significant one. That's why he went short, but he only secured about 1 R. So if he left 4 R on the table. So bearish structure for the past few weeks, was expecting continuation short, saw lower highs, lower lows on the high time frame, and was targeting the next lower high. I want all of you to also see how this trader pay attention to all of the little details. He actually take note of all of his pre-trade thought process and also post-trade thought process. Post-trade means what are you thinking after you have done your review? How could it be possibly better in terms of management, in terms of exit, in terms of your entry model, etc. So you can actually see he had the pre-trade thought process. He got the trade management, which is what happened in between, when you're holding the trade. How do you manage it? What's your thought process? Then you have the post-trade thought process, which is after he closed the trade, he reflect and he review on how could he possibly have done things better. So this is also a perfect example of a profitable trader, because he pay attention to every single detail. So this trade, what I will say is stop loss wise is a little bit too tight. It was also another perfect trade. Stop loss, it wasn't that tight considering he has about a 24 pip stop loss, but after seeing price doing a squeeze, we really weaken and we show signs of exhaustion. these are times where you perhaps should just take a step back and say, hey, market is not ready to launch yet, especially we have such a clean sell to the downside, breaking out of the previous low. Right now we're forming a retest. So when you see price action like that, it's just not the most ideal timing to go short, unless you see price fail to follow through, push back up, then you can go back long after you see the shift in structure, clear momentum to the upside, then you continue trading the bullish on the buy side, trading the pullback. Euro Aussie, a loss. For this one, I will say the second trade could have been avoided. So two separate position. So you can see this is what we call having the re-entry criteria wasn't the best, because when you're looking to take a long like that based on one of our pattern, which is TPF, when after you see price meltdown, you shouldn't be going back onto long. The right way to go back into the market is always waiting for price to reverse back up, holding above the initial entry zone, because you have to understand there's something we call an invalidation point. So when you get stopped out, market is basically telling you you're wrong. So after you get stopped out on your initial entry and you get stopped out on your initial SL, right? Anything below your initial SL and your initial entry are considered a no trade zone. You're not allowed to get back in until you see price reclaim high above your initial entry. That's when you're allowed to have a second attempt and put on the second risk. Because you get stopped out once and you take a long here again, you are indirectly killing your system, because you are basically betting, you are doubling the risk, because market is already telling you you're wrong and you get back in aggressively at the lower price point. What are you really looking for? It's no longer the same trade idea, it's a separate one, but you essentially double your risk. This is something that you have to think about as well. Lots of traders, they over risk, they sort of magnify their net risk exposure, not because they don't have a static risk per trade. Most traders, we have a 1% risk per trade, right? But the problem is often traders risk 1% per trade. After they get stopped out, they add into the loser, they add into the loser, add into the loser, without a clear criteria, without a clear principles telling you, hey, under what circumstance am I allowed to get back in? That's what we call a re-entry criteria. So in this case, he just shouldn't trade that anymore, should have just walked away. Pound Aussie is a win. So yeah, bearish. Yeah, I was bearish on Pound Aussie as well, but clearly we are wrong, as price eventually still reverse all the way back up. But the setup's pretty clean. So we got a clear resistance at 194, 195, I'll say 195, which is this circle red zone. Then if you scroll down, you may realize that, hey, price printed a double top, fake sort of swept the 195 high, come back lower, formed a TPF formation, and we continue drop to the downside. So that's also another very, very beautiful setup. US oil, so this one not the best, considering you are rather late onto the party. You see that? So drop, 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 drop. Which wave are you catching? Possibly the 5th or the 6th. So when it comes to trading continuation, there's one main criteria that I assess is also, am I early or am I late to the party? If I'm being too late to the party, there are times where I will either I size down because it's no longer a plus quality setup, as one of our main criteria grading the quality of a setup is using our price position. So when your price position is poor, you're not allowed to go in. You're allowed, but you are not allowed to go back in on the same size, because it's not an A plus setup anymore. Price positioning is one of the key factor that a key filter we have on our grading system. And another thing is, not sure what pattern is this as well. Market is technically, looks like it's just chopping around, and after you see such a heavy sell off candle and price managed to recover this all the way up, don't you feel something's wrong? Yeah, buys are trying to recover things back up. And anyway, It's not the best setup, but I do understand the thought process because he saw the clear downtrend and he's looking to participate on further sell on the further sell side. So it makes sense. Move on to euro dollar. This is also a $250 loss. So I'm not sure why there's no clear journal. We're skipping this. Yeah, such a beautiful trade. Yeah, but anyway, no follow through. This is actually a perfect trade. So heavy sell, he's looking for a continuation plus a TPF for a continuation to the downside, but there's no follow through. And that's the reality of trading. Not every single trade are perfect, and there are times where we just have to accept the fact that, you know, sometimes market just proves us wrong. And not every losing trade, not every break-even trade is a bad trade. This is something many people do not. They fail to realize is they keep determining the quality of the setup, how, whether if it's good, whether if it's bad, based on the P&L. If you start judging things based on the result, which is the P&L, you find yourself getting confused on what's really good, what's really bad. The main thing is, remember, the best setup in the world, the A+ setup, whether if you have 1 confirmation or 10 confirmation, they may still fail. The only difference is once you know how to identify an A+ setup versus a low quality setup, you then know when should you be risking a little bit more. And that's the important thing about having a grading system, is to allow you to avoid losses and focus on the high probability winner. All right, move on to euro dollar. This is, I'm not sure why you have that many entry, but anyway, that wasn't really a good trade. Market was just ranging sideways, not sure why shorted there. A re-entry here, this one makes sense, but still, after seeing price keep printing higher low, higher low, higher low, you shouldn't be shorting anymore. So move on to euro dollar. This one is a 4.5 hour trade, very beautiful. Yep, so what happened was he identified that the market was printing key level rejection here at 1.1954. That's why he went shorted once, scaled in. Very beautiful, very beautiful. Aussie yen, this is also a good setup, but unfortunately there's no follow through. So clean resistance formed at this red zone here, price fake out, come all the way back down. Market even showed reaction here, pushed all the way up, crashed all the way down, confirming that sellers are back in control. So after seeing this kind of heavy meltdown candle, normally we will conclude that sellers are back in control. Then obviously we continue the chop. The only one thing that I can say is market is getting a little bit choppy. And one important practice that I always have is when I see price keep going, it keep piercing back and forth of a zone, I always have the rule, the criteria to remove it, to take it away. One of the key problems traders make is always something like this. So for example, they have a zone here and they see price do this. Let's say they put the level here on 10th of October, and after price chop back and forth for another half a month, and they still keep the zone here, let's say until 1st of November. When you do that, sometimes you'll confuse yourself, because support and resistance are memory zones, and memory zones are exact level where the bigger players are interested to participate, because the big players, they only care about price level. That's it. They don't care about anything else. They don't care about the SMC. They don't care about the fair value gap. The only thing they care is at what price do I want to get in. If you speak to any institutional trader, they will always tell you they are price sensitive. Their system is to ensure they execute the orders that they want, the orders that pass down from the top management, and tell them, hey, I want to execute, I want to buy certain things at this price range. That's their only job. They don't really care about some of the complicated concepts that some of us use. The only thing they care is keep price level. That's why I love trading price action, is because we are essentially trying to understand how price move rather than trying to predict a certain thing. We're being reactive rather than anticipative. We don't predict the market, we react to the market. And that's the essence about price action trading or price pattern trading, is because price pattern shows price behavior. Price behavior shows emotion. Okay, so back to it. So if you see, price action keeps chopping back and forth a certain zone, just take it away, because you see what happened. You end up just focusing on this zone where market is already telling you, I don't care. You see here, the first time it says, I don't care, 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 and you are still shorting it. So something worth reflecting. So this is a short made about 1.9 R. Yep, but this is not something that I would go short, because overall price action is bullish from a short term. After having the multiple exhaustions or rollover to the upside, it shows that price is fairly strong. That's why it's not something that I will personally go short. But anyway, your initial CP was 4.5 R. After seeing price hold the support at 109.52, I panicked and exited the trade, expecting price to reverse. Panic and exited the trade. So you don't have to be panicked, honestly. All of the trade club members, every single of you are, you understand exactly what you're looking for. So when you take a setup, just let it run. There's no point trying to quickly break even the trade or trail your stops. And that's one of the common issues as well, right? Most traders, they quickly try to break even, or some of the system out there, they always tell you, quickly break even, quickly trail your stops, because they have zero confidence to hold on to the winner. That's the first thing. Second thing is, probably they don't have an edge. That's why they quickly want to manage it, because they don't even know what they're doing. So if you know what you're doing, it's important for you to stick to the trade and to stick to your winner. So euro dollar, yeah, but again, it makes sense. But when you're trying to trade this kind of pro trend or sort of wait, give me a second. When you see such a strong price action to the downside, it's also important not to predict a reversal. And the same thing goes to euro dollar. Although it's still a decent trade, because I understand your thought process, but it looks a little bit too weak. Yeah, that's pretty much it. Move on to pound dollar. Also a beautiful trade. Although it's a stop loss, you did not put on the post-trade analysis. Although it's a stop loss, but the thought process is pretty good. We have a key level here, we fake out the low, we pop back up, and you look for a retest. So it's a beautiful trade. Although you get stopped out, I can see here -1R, but it's still a very, very beautiful trade. Then pound Aussie, why would I not trade this? Is because just look at the overpriced action. Way too choppy. When the market is chopping, when it's just ranging sideways, just avoid it. Pound dollar, yep, you shouldn't be losing twice here. You get stopped out once, you shouldn't get stopped out twice. Even if you were to break even on your initial position, it's still not the best. Why? Because when market is already, it shows some sort of consolidation, just avoid getting in the middle of the range. That's what we call a mid-range entry, which has a very low probability of success. Then this one is where we get back in, but anyway, it didn't work. So that's pretty much it for the trades review. A few improvements here would be, first thing, have a realistic stop loss placement, because I realize some of your stop loss are placed quite tight, and that could be a problem that might worsen your win rate. The second thing is, have a strict re-entry criteria. Make sure you know exactly what you're doing, and avoid getting back onto the same loss without price validating your thought process. And the third thing is is to really try to understand all of our patterns well. Let it be a TPF, BNR, rollover, exhaustions, flag. Understand the pattern well, know when to use them and how to use them, in what kind of market condition or what kind of context. Only then you will truly know the power of some of these patterns that helped, some of our traders here. They really do well. In order for you to really get to a level, you need to have deep understanding of the pattern, do enough back test, do enough forward test. By then you will know, hey, under this condition I shouldn't be using a TPM. Hey, under that condition I shouldn't be using a break and retest, maybe because the market is very volatile. It has opportunity, it has possibility of sweeping highs or low. Or under this condition I shouldn't be trading a break and retest because market has not broken out of the range yet. So these are some important things that you can learn from and really ask yourself. And that's it for the video.